Hi all, this is Akshara Menon from PMS Bazaar. I'm thrilled to welcome you with another round of a webinar on today's topic, navigating sector rotation in small and mid caps post-election. With markets reaching new highs and many investors are concerned about the valuations being expensive. Major Indian indices are surpassing 24,000 and Sensex are already verge of hitting its 80K. And this creates a FOMO strategy among the investors, especially with the upcoming budget as a major event. Investors are eagerly searching for an idle investment opportunities. So, what we can expect of this webinar? But understanding how each bull market introduces new leading sectors, also driving the market. Also, identifying potential sectors that be the next bull run, highlighting the emerging opportunities and exploring sectoral leaders beyond large caps with emphasis on promising mid and small cap sectors. To delve into more into topic, I'm pleased to welcome Mr. Arpit Shah to the show. Mr. Arpit Shah, an entrepreneur by nature, is a co-founder and a member of an investment team at CAT Portfolio Managers Private Limited. Arpit brings with him 15 years of experience in capital markets. He has contributed articles and views to leading newspapers and newsletters and has been presented on equity market as a speaker on various platforms as well. CAT PMS manages approximately over 900 crore INR of AUM through two of its strategies. One is a CAT PMS growth plus value and the CAT PMS large and mid cap. While the large and mid cap strategy was newly launched, the GPV, which is growth plus value, has delivered over 22% CAGR in last decade. ARPA is also a chart account by qualification. Before moving on, let us cast a vote on which sector is likely to grow in next 5 years. Can we have the poll on the screen, please? So viewers, you could see the poll. You can click on them. Whichever you feel is going to grow for the next 5 years. So can we flash the results? So the results all here. No?
Perfect.
So the major is from the power and renewable sector. So what is your view on it, sir? Before we could start the webinar, if I could ask.
Probably we will take this poll again at the end of the webinar because this is highly on expected lines. Okay. So there's no surprise for me at least. So, people try to invest where they have already missed past rally. So that is what it is more about psychology instead of valuations or, financial metrics.
So we'll take this poll again after the webinar.
Yeah.
So let us see if the ratios have changed.
Yes.
Yeah. Thank you.
So first of all, thank you, Akshara and PMS Bazaar for giving us this opportunity. I thank everyone out here to spare some time and attending this webinar. So first of all, thank you everyone for joining in. Thank you PMS Bazaar again to provide us this opportunity. So here our major focus would be on and around how the sector rotation is it plays, how sector rotation happens, what are the triggers, what are the cautious, and since we are recent macro event was the election, we will see if there is any trigger related to government policies which can impact some more sectors. So before I start with my presentation, just a disclaimer that we may have exposure to companies or sectors that we discuss, or we may have some contradictory view also, even if we share some contradictory view to the presentation also, or personal capacity. So with this, let us understand first how the sector rotation has happened in past. So if we see from 2014 to 19, I have taken last 10 years history only. So Nifty on an average has delivered 12% CAGR return. And in the Nifty sectoral indices, the major was the consumer durable, which delivered around almost more than double 27% kind of CAGR in 5 years. Similarly, banks and financials during this 14 to 19 period has done well. If we look at the bottom, of course, the metal was one of the laggard there. media was laggard, reality was only single digit. So this is the background of 14 to 19, how the sectoral indices has performed. Now, if we look next 5 years from 19 to 24, market on an average has given 14% CAGR in 5 years. Please mind this includes the period of COVID during 1920, 2021. So bottom of the previous sector, a previous bull run like metal and reality was it looks like they are the best performer in next 5 years, and probably the previous sectoral best performer like financial services and banking have been laggard in the next 5 years. So how do we see this? This is just this may be one of the coincident, but this is actually the sector rotation I want to highlight. So in 14 to 19, we have seen the financial services, consumer durable as the best performer, while in 19 to sorry, in 19 to 20, actually financial services was laggard, and of course FMCG was kind of lower than the Nifty returns. In 19 to 24, metal has actually delivered 24%, 23% kind of CAGR, but reality 29% kind of return. While in 14 to 19, so previous 5 years, metal was into laggard list. So how this sector rotation impacts? Is there any logic, or is there any trend that we can identify? So I have jotted down few points. Normally, sector rotation happens because of the first trigger is of course the re-rating and financial changes. So let us understand how the 14 to 19 and 19 to 24, what was the financial, what was the valuation of the sectors. See, if we see the earning growth, okay, in metal there was lower single digit of growth between 14 to 19. Okay. At the same time, 19 to 24 metal, sorry, actually, I wanted to highlight that financial 14 to 19 was negative return. It is because of the some kind of bank reform that took place. PSBs took big hit, and of course, COVID was there at the beginning of the 19. However, infrastructure was the worst performing sector, minus 10%. It is about earning growth, EPS earning growth. While the post-COVID, infrastructure was the biggest compounder as far as the earnings were there. So when financials improves, automatic your re-rating happens. And if we see the valuation, so see metal which was quoting at lower kind of 13 or 11 times of PE, now that re-rating has happened because we have seen the metal, many things are happening in metal and mining sector. So valuation got re-rated at 28 times. Similarly, if we take the financials, so when financials was of course doing well, but that time because of the higher earning, the valuation was reached to around 40 times, 45 times of their earnings, which we consider as a high valuation. And of course, after that, there can be some slide of correction or probably the consolidation in that segment. Triggers for new sectors is of course like when we say the sector rotation, it is of course the company specific. We have to call it differently. But how this sector has impacted? So when we see 14 to 19, financial sectors has performed the best. We have seen the government action, government policy decisions that has impacted the re-rating of the sector, like recognition of stringent recognition of NPAs, NCLT brought into place, recapitalization of public sector banks. Similarly, for the power sector, we see the Uday's Uday scheme was announced, whereby Discom got the liquidity push. State were compelled to pay to the Discoms. So that was the impact of the government decisions and policy decisions, which has impacted the sector. Similarly, like real estate RERA was there. after that, there was demonetization, because of which the movement happened from unorganized player to the organized player, and organized player are mainly into listed space. So we get the Nifty reality indices moving 29% CAGR into 19 to 24 time frame. Similarly, government post-COVID was, with Atmanirbhar agenda, announced many PLI schemes. There was a thrust on the, making India a manufacturing hub, and which indirectly impacts the metal, which indirectly impacts the infrastructure, and that is how we have seen these sectors has also performed well. Here, since our discussion is mainly about the government policy, I wanted to highlight how the government expenditure is impacting the actual economy and how it is impacting the sectors. Because see, if we see that in 22, 23, 24, there was a higher announcement by the private sector. There were around 39 trillion kind of capex was announced total, while almost three-fourths of it was from the private players. Private capex was announced. However, when it comes to the spending, actual project completion, where actually money flows into economy, government was the largest spender. In 22 and 23, almost 50 to 60% of the monies that actually flew into the economy, that was spent by the government. So government is one of the key factor which impacts the sectoral, which definitely impacts the sectors. This is also depicting the earlier announcement earlier only, that government is one of the largest spender, that has it has its impact on the economy. It has impacts on the sectors. Government, if we see that they have capital expenditure was around 4.6% of the GDP, but effectively they have in fact doubled their allocation from almost 1.7, 1.8 times to 3.4%. So government was the largest spender. If we want to say that, that would be right word. Okay, the government was the largest spender post particularly COVID period, which has actually inflated, helped economy to grow. Why I am taking this point is because government post election, if there is any change in government policy, how it can impact the sector. That is the one point I want to highlight. So if we see the 2014, 2019 and 2024 estimated budget, defense, of course, as a percentage of expenditure, one of the largest. However, the percentage of expenditure has reduced. However, the absolute amount has increased. So if we see 2.5 lakh crore to 6 lakh crore, so more than double. However, our government's budget itself increased almost 4 times, from 12 lakh crore to 48 lakh crores in 10 years' time. If you monitor the same thing, like percentage-wise allocation, if we take combined roadways and high railways, so 3% of allocation went up to 10%, which actually has created physical infrastructure. However, if we talk about the rural and agriculture, that 8% of total expenditure has remained more or less same. It has reached to around 6%. So government's policy has really actually impacted the real infrastructure. It has created, government focus was more on to creation of the real infrastructure, like roads, railways, airports, like that. Government's one of the announcement was doubling the farmers' income. So that's why we say, and that is probably has not actually has happened at the ground level. So probably these are the pockets where government may see some policy shift, and I will take this later. I will touch base on that part later on also. This is a percentage allocation of total, that how absolute numbers, how government has allocated. Reasons for sector rotation are many, of course. However, our focus right now is on the government policy, how the change in government policy impacts the sector rotation. Apart from there can be many factors that can impact the sector rotation, like global demand supply. We saw that earlier, pollution control in China, which has actually had very positive impact on the chemical sector as a whole. Currently we are seeing some Red Sea crisis, so there is a demand supply gap. There is a logistical issues that also impacts particular sector, particular time, it in time frame. Uh, Now, if we want to recap the first part, attractive valuation that we discussed is one of the key reason for the sector rotation. Industry tailwind, because of the various government or other macro event happening that impacts the industry. Government is of course the driving force as far as the Indian economy and the what our today's topic is about. Of course, the government is one of the driving force to change which impacts the sector rotation and the capex cycle. So these are the few pointers which impacts the sector rotation. Uh, Let me take you through how the election has impact. What is the impact of the election, which can be change the government policy. Of course, let me share the. Let me give you a disclaimer that these all are the assumptions. What I'm going to say, that is based on the government's recent speeches and what the actual we are seeing on the ground level. That what is the government's approach. So what has changed? So post-election, of course, the continuing Modi 2.0 continues for the Modi 3.0 as well. However, tally numbers are lower. Almost 60 seats they have lost. Uh, where they have lost these 60 seats, this chart is kind of it is showing the where what which are the rural areas, where the rural areas and how what is the result impact. So if we see, there are almost 30 seats which is lost by the NDA or more than that in the rural areas. And probably the more than 40-45 seats are gained by the India alliances in the rural area. So has this any impact? Like, if we check some of the reports that of course rural was having so much pain because of the higher inflation, lower farmers income. If that was also that was also visible from the FMCG sector companies reports, automobile sector reports, that rural was not picking up. And actually government has lost some of the seats or majority of the seats in the rural area. So there can be shift of the policy government where there may change from the physical infrastructure to the where the it can be kind of a populist budget, or it can be the kind of populist government where you can see the some allocation from of the government may go to develop rural farmers income. And that is where we have shared this earlier also, that government has increased their percentage allocation from 2014 to 24 to physical infra of roads and railways to 3% to 10%, while their allocation to chemicals, fertilizers, rural agriculture has remained the same into 14% to kind of 10%. So these are the pockets where probably government sees some more allocation. It may be because of the impact of the election, and because the government is now focusing more on it right now also it is available that there is discussion that personal income tax slab can be reduced, so to have more disposable income on the public's hand. Uh, Government's immediate action also testimony is giving testimony to this kind of assumption that first step the PM Modi took was release of the PM Krishi Nidhi, which was around 20,000 crore while joining the office. Immediately, minimum support price has been increased for 14 crops. Uh, the one important point wanted to highlight is that all the ministries, if we take about defense, uh, home ministry, all the ministry, key ministries, finance, everything remained the same. However, one ministry got changed, which was rural and agriculture. And government has brought, or PM Modi has brought his, trustworthy Mr. Shivraj Singh Chauhan to that ministry. That itself indicates that government is becoming more serious to how to increase the income in the rural area. So when we talk about rural, uh, there are, of course, because of the government policy, there can be change in the government budget. This budget will give us the 5 years time frame, 5 years horizon. What will be the government's priority? Apart from government, apart from government budgetary expense, there are other positive factors which will definitely complement to the growth. So one is monsoon. That monsoon is expected to be above normal. So far, of course, it is into deficit, but it is too early to say. Overall, IMD is expecting that 106% can be the rainfall, and it will be spread across the geographies. So this will be complementing to add income into rural area. Similarly, if we see the last 3 years, price movement, probably agriculture and agrochemical companies and FMCG are kind of laggards in vis-a-vis Nifty 50 or Nifty midcap. So there can be reason because of the rural economy is not doing well. These companies are directly impacted by the rural economy. So we have seen there are kind of a laggard, or they are underperforming the broader indices. Now, what can be the possible? What are the sector that can have direct impact? So, rural economy per se is contributing almost 40% to the overall Indian economy. It is giving 60% employment to our working population. So, directly or indirectly, if rural is doing well, overall many industries and many companies in that industry certainly will do well. However, we have done some cherry pick uh, based on some of our assumptions that which company, which sectors one should look for. So, agrochemical and seeds, of course, one of the most beneficiary sectors that can benefit if we see these things of happening, like government policy plus the proper rainfall and other things. Similarly, auto, particularly in tractor tiller industry, auto ancillary, or auto, the beginning segment of auto, there have there have been a good exposure to rural economy. Banks, NBFC particularly, they can see some good revival in their lending. So these are some of the sectors that we have cherry picked. Uh, and these are the kind of exposure that we expect that to happen. Now, if we go by the sector rotation, and if you want to play that theme, what are the pockets or what are the options available? So, if we say, let us say that agriculture theme we want to play, there are almost 89%, 89 number of companies, of which 88 falls into small cap. Similarly, in agrochemical, 24 out of 24, 22 falls into small cap and 2 into mid cap. So, in even for many of the sectors and many of the companies like dairy, 8 companies are there in the listed space, all 8 falls into small cap. So, of course, when you go for the sector rotation, one has to be very vigilant, because the majority of that, some of the companies we don't have, some of the sectors we don't have indices also. Like if we say dairy, we don't have indices also. But one has to be vigilant. If you want to play rural theme, we want to play agri related theme, we want to play dairy theme, then one has to look for beyond large caps. And that is where one needs to be little more expertise. He needs to be more vigilant, because small cap also into 88 companies, or 159 companies in auto ancillary, you will have to pick 1 or 2 companies. So that is where the need of an expert arises. uh, why that is required? Because see, in last 1 year or 2 years, we have seen that defense theme has played very well. Everyone is aware about it. So overall defense indices has delivered around 5 times. They have made 5 times. While two of the known companies into defense industry, BL and uh, HL, they both were underperforming. They are still underperforming the broader indices, while one company, Mazgaon Dog, has actually delivered 15 times return. So even you want to play the sector rotation, selection of the company plays the very vital role. So this is very important point, because you just can't play blindly the sectoral play. You have to go for the bottom up approach. So what should be the stock selection approach? It is top down versus bottom up, or I would rather disagree and I will say it is top down and bottom up approach, because you will to outperform the market, to outperform the indices, definitely you will have to you will need a tailwind in the industry. But at the same time, you need to be very vigilant about the company selection, which companies you are buying. uh, this is kind of kind of cautious, where we can discuss the poll result here as well, that uh, where where do you think that sector rotation happens? Because of two things: one, the new sectors coming in, and where one should exit. So undoubtedly valuation is one of the key factor one should monitor to think of the exit. If we see the infrastructure play, it reached to its peak at somewhere around 38 times, because many of the companies were into losses into infrastructure play. However, still it is at reasonable valuation. If we see the FMCG, which actually had done very well between 14 to 19, but it towards the end of the 19, it reached to its peak at 47 times of its valuation. Today also it is at 42 times of its valuation, its earning. So if it doesn't catch up the earning, probably the valuations are high. So one can avoid the sector rotation, one can avoid the sectors which are valued high, unless and otherwise the earnings catch up later on. The second and the most important trigger for exit can be FOMO. This is very one of the example, and it is only for the for the education purpose. So if we see, there are sorry, oh, I'm sorry. There are actually, we see some distribution number of, if you see the public participation, number of shareholders has increased in HL in last 2 years from 2 lakh to 7 lakhs, so more than 3 times. Okay, and there is of course increase in FIIs holding as well. However, retail participation has increased a lot, and that is where we believe that this kind of FOMO, feeling of missing out, is one of the trigger that is that you can't see on the on paper, that you will have to feel. And that is where our poll result will come into play, that okay, everyone wants to still invest into railways, but no one is looking for the agriculture, because agriculture has not done anything in last 10 years, in last probably 8 to 10 years. So these are the few triggers where one should be vigilant if we want to exit, or if we want to partially exit. I by no mean I am saying that okay, this has reached to its saturation, or this has reached to its higher valuation. But if we want to book some profit, if you want to encash some opportunities, these are the triggers which one should think over it. How CARE PMS has done its sector rotation. So we have exited IT completely in March 2022. So we were expecting some disruption because of the AIs. We saw that because of the Ukraine war, because of the higher inflation, the overall global economy was into in different zone. So there was of course cut in the IT spend, and we have exited IT space completely from 8% to zero. Where we have increased is kind of textile, where we see demand is happening because of the China plus one, because of the garmenting manufacturing. Many of the textile companies are now into advanced material, kind of a technical textile is part of their business. So gradually we have increased our exposure from 4% to 13%. Similarly, stationery, like post COVID, we saw that there is a brand consciousness is among the students, particularly among the office. We see that on many unorganized player went out of the business. So there is of course the trigger of of sector is gaining the opportunity. Sector is gaining probably sector is getting re-rated. So that is where we have played. Mining and mineral, I will share many examples of also. We increased it to 11% of our total portfolio, and right now we are not holding anything. Mining, there were many triggers. So these are some of the incident where CARE PMS has played its sector rotation because of the top-down approach. Mining, as I was saying, that government released around two or three amendments and mining bills in less than 21 days in somewhere around 2020-22. So mining reforms, which government become very serious about, started exploring, the rare earth mineral. Government was very much interested to become independent and self-reliant on the rare earth mineral. And of course, no government would want that, okay, the core of their manufacturing base like rare earth and other things, if they want to make India as a manufacturing hub, they would like to have control over the mining exploration. So of course PSU mining was one of the thing that we kept in mind, that okay, government will not dilute its stakes to control the overall production manufacturing if they want to manufacturing hub India as a manufacturing hub. We saw some of the top level management changes. Hasmukh Adhia, the person who implemented GST, the can be considered as a you know right hand of the PM Modi in financial reforms. He was appointed as a chairman of the company called GMDC, which is less than 5,000 crores of the market cap. And when he joined the company, the first line he said was that for me the total enterprise value should increase to 15,000 crores. So these are the some of the triggers that we saw. Financials, mining companies are always were very good. Valuations were always into lower single digit. Dividend yield was good. So this kind of the sector rotation sector, there were some triggers in the sectors and how we have played it. So we entered GMDC at somewhere around 166. In 6 months, we exited with more than double the money. Similarly, we added NMDC and exited with around 80-85% kind of growth. Similarly, we played with Coal India, 230 we entered, and we exited with more than doubling the money in, let's say, 6-8 months. So these are the cyclical play which CARE PMS has done. As I said earlier, also stationery also one of the sectors that we saw there is a trend is happening, unorganized to organized, reduction in imports because of the China post-COVID. China import from China was becoming difficult. There we played one company called 𝐸𝐞𝐚, and that is these kind of companies you find in small cap. You don't get into large and mid cap. This can be considered as unidentified or hidden gems. We entered it somewhere around 87 rupees. Still, we are holding majority of it, but it is almost doubled since we have entered it. So with this top-down approach and bottom-up approach, how CARE PMS has delivered in last 13 years. So since inception, we have delivered 23% CAGR versus BSE 500 around 14%. So if 1 crore invested at the time of inception, July 2011, it is approximately 7 crores value today, net of all the fees and expenses. What is our current portfolio construction? We have this is more mainly about GPV strategy, growth plus value strategy. We have constitute of under 18 to 20 companies, 8 to 10 sectors with cap of maximum 20% exposure to a single sector and 15% exposure to a particular company. Regular review, rebalancing, part exit, full exit, that is part of the portfolio strategy. As of today, this is where we have higher exposure, 14% into JK paper, which is falls into paper and packaging. We have after JK paper, we have our highest holding is cash. We are sitting somewhere around 11% in cash. Sector wise, the second is the textile, where we have Arvind and PDS. Interesting part is that, even though market is at all-time high, our portfolio is also at all-time high. Our weighted average PE is still into 22 times of its earnings, its TTM earnings. So we are quite comfortable sitting as of now that holding our portfolio, because if we compare it with the market where all the indices which are their valuation, we are fairly valued. I would not say it may be, considering current market, we can say that we are undervalued. And our top five companies has done really well. Their 3 years PAT growth is also into high double digit. Their top five companies has 47% of our exposure is into 40 top five companies. Plus there is 11% cash. So it is kind of very concentrated portfolio that we built for our clients. So key takeaways, of course, all the new leaders as a new for the new bull run. You may see the sector rotation and new leader for the new bull run. Sector rotation is a continuous process. I took a time frame of 5 years just to see link it with the government and government policy. But sector rotation is a continuous process. So every year, probably one new sector you may see in the portfolio, or you may want to exit into from the portfolio, one or two sector. It is a continuous process. Uh, Wealth creators are outside top sectors. So, as I said, many companies don't fall into large cap where you don't have even indices. Let's say who was talking about the defense in 2018 or 2015. Okay, who were talking about the PSBs or mining sectors before 2017. So those sectors probably are ignored sectors, but they were the wealth creators in recent history. So you will have to look for the changes, what is happening at the macro level also, and many of the companies which are not part of the large cap but into small cap companies. Uh, you have to apply, one has to apply bottom up as well as top down approach to maximize the returns. It is not that one can play as we share with you that defense play. One cannot just play blindly with the sectoral rotation. They have to apply their brain. They have to build conviction. They have to understand the valuation. And so bottom up and top down, both the strategy should be applied at the same time in the same portfolio to maximize the returns. So friends, uh, with this, I just conclude my presentation here. I open the floor for question and answer. Thank you once again for the listening to this. Thank you.
Yeah.
Yeah.
Now, thank you, sir. Thank you for the elaborate one. And I think you've covered most of the part in this PPT. Most. So, can we have the poll again? Can we just check
Yeah.
if there's any change?
There
So,
is a
can we have
star.
the result?
Yeah.
Can we have the result? Okay, now that's a significant change because I could see
Star.
fertilizers have taken the better position when earlier it was power and renewables. That was I could see the changes.
So thanks. Actually, so at least all the listeners were awake during the presentation.
Yes, true. And I just want to add one
Yeah.
thing towards it. So we had webinar with you earlier, and back in
Correct.
2022, and there was a
Yeah.
time when you bet on defense sector
Correct.
when it was
Correct.
just 30% up, and it did
Correct.
it did rally after that.
Correct.
And
Correct.
today you're betting on chemicals as such.
Correct. Correct.
So
So
yeah, you
very
want to
yeah, very nice question. Very actually, I wanted to highlight that. Post election result, we have seen that around 40% all the companies have moved in the particularly fertilizer companies as well, fertilizer sector as well. Okay, so uh, when there sector rotation happens, it happens for the longer period of time. Okay. So when we were pitching defense in say August 2022, right? So that time also defense has already started moving up. We could see that HL and other companies were up around 40% from their recent lows, 40, 45%. But when we saw that, okay, sector rotation is happening, their earning growth is there, there is a valuation still, there is a significant valuation gap. So probably that rotation and that sector will be into bull run for next 2-3 years. And in the small companies, when you see 2-3 years time frame, you definitely will make multiplier. You will see the multiplier impact. So, so that is one thing one should consider, that okay, 40% from recent bottom is not a thing that okay, the Tej is over,
Okay,
the
the
bull run
valuation
is
is not
over in
still
that
high.
particular. Yeah. There is too
And
much steam left, and sector rotation happens for the number of years. It cannot be for the short term period. And probably if it is for the short term period, one should not play the sectoral thing.
okay, correct. So when you say the sector rotation part of it, no sector is in green always. There is
No.
always an up and down in a particular sector. For example, if you're going to take manufacturing as a sector, let me take an example here. Like back in 2017, when Apple wanted to, put their manufacturing in, it was not. We didn't have it, but today we have 12% of it. So we could see that increase directly. So how do you look into that particular, sector rotation, that kind of thing?
See, one has to be very vigilant. As I said, at the time of, one should also consider exiting from the sectors. Okay. What happens that there is a psychological impact of FOMO, which leads to the higher valuation of a company or a sector. Okay. Feeling of missing out. That is actually the bigger threat. When you say that people stop using their logic, people stop evaluating the company based on the merits, but they just want to participate in the rally. And rally, where do you want to participate in the rally is the talk of the town. So that is what always happened. Like if you see the banking and financials earlier, there were, PSBs were completely missed out. No one was interested to talk even about the SBI, the largest bank of the country. Everyone was interested to invest into private banks. So that reached to that valuation saturation. Of course, those companies are doing well. They are great companies, but you have to understand the valuation part as well. So, it is not that you just have to blindly follow the sector. That is what one should keep in mind. And it will always open. Once that is reached to a saturation, the smart money will chase the valuation. Right
So
now,
when
what is,
yeah, please, sorry, you continue.
yeah. So smart money will chase the valuation. And the valuation, of course, the current valuation, future valuation also you need to keep in mind. So in metals, many of the sector companies were into losses for a particular time frame. So you say that, okay, probably valuations are high, but you see the turnaround. So earning growth, valuation re-rating happens. And probably if we see 2 years down the line, 3 years down the line, the current valuation are quite reasonable.
Okay.
Yeah.
But when you say that, of course, when you say about the valuation part, there is always a restriction in one particular sector. So if it is, if which sector do you think would have a disruption next 5 to 10 years from now, and how is your portfolio being constructed, to or mitigate that risk?
So, see, sector rotation, as I said during my speech also, that it is a continuous process. One has to be very vigilant. If you ask me that one particular sector that can see the disruption, probably the power, or probably the because many new renewable power sector, renewable power theme is going on. So probably the power generating companies, discoms, may see some kind of changes, because everyone now, government is also focusing on solar for each and every house. So how they will be connected to the grid. So disruption can happen in any sector. Like, fintech company, who could have imagined that it will have impact on the largest banks?
Yeah.
Okay. Small fintech companies are too large right now. So we are open for it. It may happen in any of the industry. It can happen in any of the companies as well. So we have to be vigilant. That's the only solution available.
So I'll take a question from audience. Is that
Yeah.
does it make more sense to observe sector momentum instead of stock momentum in the momentum strategy? How does growth plus valuation strategy compare with momentum strategy? You want to answer this?
Yeah. So there are two questions. One is first is about how. Can you repeat the first part of?
Like how to observe sector momentum instead of stock momentum.
So there are triggers, like we said mining. So government was outspoken about the mining sector. Okay, there are government. So government is one of the trigger, right? So when China, there was happening that China plus one. So we could see that which are the many major imports from the China. What are the major exports from China which can be replaced by India? So EMS theme that played very well. Everyone was sourcing from the China, electronic manufacturing, electronic goods and other things. That started outsourcing into India. So sectoral theme happens. So there are macro factors that you should be vigilant. At the same time, you will have to also understand the company specific, because see, if there is a company specific approach also, you have to apply, because see, if there is a disruption in China, say there is a pollution control and particular chemical industry is doing well. It is not that all the chemical company will give you the same result, because some companies may not have that capacity only to produce more chemicals.
Okay.
So top down will give you the trigger. One important is that while investing into company or selecting a company, industry tailwind will maximize your gain. Like we were very confident about the mining sector, mining companies. We were quite confident about its valuations, its dividend payout, their royalty, their monopoly in their business. However, government started giving hint. Okay, now this sector is, we are very serious about this sector, and that lead to the re-rating of the whole sector and the company specific. So that's how we played the mining sector.
Yeah, but you being one of the players for the smaller mid cap, and the total AUM of CARE PMS is 900 crores, and out of which 70% is into the growth plus value. Because
no, 95% is into growth plus value.
95% growth. So how do you differentiate yourself from the other smaller mid cap players out in the market?
So first, it is a CARE PMS is a boutique PMS company. We don't have any other assets. We don't have any other business. Of course, one of the key reason is 13 years legacy of 23% CAGR return, which almost 14x your money becomes 14x in last 13 years. Our conviction is one of the thing probably where is a differentiating factor for CARE PMS. Like we never shied away from having a JK paper, which is a very dull sector, paper and packaging. You can say old economy stocks. We are holding highest holding in JK paper since I think 2018. We started buying somewhere at 90 rupees, 100 rupees. Okay, at 550 also we are holding it. So that kind of conviction, is something that I think sets us apart from other players. Together with this, we don't deviate ourselves from the valuations part. So we have not participated in many so-called many themes only because of the valuations were not in our comfort zone. We stick to our basics. We stick to our financial. We stick to our confidence on the management, and we stick to our basic principles of growth plus value. There has to be reasonable growth in top line and earning, and it has to be reasonably valued. So, for me, risk reward ratio has to be quite much favorable. So I don't want to participate in each and every next big thing.
When you talk about, sorry, please. When you talk about, paper and packaging sector, sorry to interrupt. When you're talking about, you gave around over 10% of allocation in that particular sector. And how these companies are adapting to strategies to meet their growing demand and being more durable, to sustainable solutions into e-commerce area. So there is a gap that should be answered.
So see, JK in paper and packaging, we have only JK paper. So I will talk about JK paper only. Okay, so if you observe JK paper from 2018 till in last 6 years till today, so they have changed their business from pure paper and writing and printing paper to now more of a packaging company. Okay, and that was the capex announced by them, and that was actually the trigger for us. that it is now going from the pure play paper and writing and printing paper company to the packaging company. They bought a new plant. They bought a company from NCLT. At the same time, they, last year they bought a company into corrugated packaging. So these packaging and corrugated packaging are directly linked with the growth in FMCG and the packaging sector, and which are actually, so if we talk about writing and printing, they are growing at lower single digit. Okay, while packaging segment industry is growing in higher double digit, 12 to 15%. So that shift was visible. At the same time, they were industry leader. Their balance sheet was fantastic during the COVID time when schools were shut, when there was a liquidity crisis. They did 100 crores of buyback. So
Okay.
that was a confidence of the management. We could see the vision of the management. How they are transforming their business. And surprisingly, when we started buying, it was at 14 rupees earnings per share,
Okay.
and quoted at somewhere around 90 rupees. Now, reasonable earning for this year would be somewhere around 65 to 70 rupees, and still it is quoting at 550 rupees. So even after making 5 times my money, still it is undervalued for me.
Okay, when you talk about that, so when the moment any investor hears about small and mid cap, the second thing that comes into mind is about multi baggers. So in your 10 years or 13 years of it, so have you found any multi baggers into your portfolio?
Yeah, many. So of course, when you say multi baggers, so small cap may, if you don't find, but you are not
Yes.
able to find multi baggers, you will not be able to outperform. And so JK Paper, of course, is one of the key multi-bagger. In earlier years, we had a higher exposure to KRBL. Our second exposure, Dawat, we initially started buying at somewhere around 20 to 25 rupees. Today it is 250 rupees, and still we are holding it. We bought KRBL also, of course, into same Basmati industry. Then we had one MPS into kind of IT related industry. We have Saregama, which pre this bonus and pre split, it was at 400 rupees. Right now, after split, it is somewhere around 400 rupees.
Okay.
So there are many multi baggers and different time of horizon. But at the time of purchase, we don't see it as a multi bagger. At the time
Okay.
of purchase, we just see that okay, there is growth is visible, valuation is comfortable, management is good. Those are some of the criteria which makes us to believe that okay, let us start investing into it. And gradually that that conviction builds on, we when we interact with the management, we understand their vision. Gradually, that conviction builds up.
Yeah, and also taking questions from the audience. There are a lot of questions falling onto the podium, and let me take one of the few questions. Like there are two or more asking about the power sector and their opportunities and the supply chain constraints. So if you want to answer that, power sector.
Uh, Power sector, see, it will be government's focus, first of all. And we see, apart from majority of the power sector companies are government or state-owned companies. So the government is serious about it. So company-specific call we have to take. Like, PFC, we saw that government changed some regulation, like they have to, consider some kind of NPA, some percentage, which can impact their bottom line. So company specific, we have to take a call. But power sector in general, it is into bull run. There can be some shift from traditional power to the renewable power and some solar panel. At the same time, some EV theme may come into play for the automobile. So company specific call would be more preferred.
Okay, so when I understood from that your ideal is Warren Buffett, and he follows value investing, but
Yeah.
you're into growth, a growth type of investing. So and you motive most of both of your funds have 70% of growth in it. So like, how do you find this contradictory?
So, of course, Warren Buffett is my idol, and I think any value investor will see Warren Buffett as a idol. Uh, so we are following the value. So having exposure to small cap doesn't mean that we are pursuing growth only. That is visible from our weighted average PE as of today also. When markets are high, when my portfolio is also lifetime high, my weighted average PE is around 21 times of its earning. So it itself shows that we are very much value hours kind of people. Growth is something where you get a key, you get a re-rating happens because of the growth. It is only if I follow the value, I won't be able to make much money. And if you remember, Warren Buffett also changed his view while buying the Coca-Cola. Okay, he also started paying premium for the brand name. He started paying premium for the scalability. So that is what we will also be. Anyone should do it. Only value is value without growth will not give you any returns.
Got it. So let me take a question a bit more personal, like a person behind the profession. So you're a Gujarati, and what makes you think that Gujarati particularly, adapt to money? Like, is it a cultural trait or just a mere perception that we have?
So I will like to add that I'm a Gujarati and a chartered accountant.
Okay.
So so both put together, it is inevitable that one person Gujarati and chartered accountant is not into market. No jokes about, but yeah, Gujaratis are normally what I have seen.
And you're the first generation entrepreneur here. Again.
Yeah, I am first generation entrepreneur into this business. My father was also a businessman, but he was into a different industry. Yeah, he was into different industry. So as a Gujarati, or probably as an entrepreneur, we have got very good risk appetite. We don't mind betting on our conviction. So if personally I want to share my example, in 2011, with very limited capital, with negligible source of income, I had 100% exposure into one particular company only, 𝐸𝐴. I can name the company also. But that played well, and I made around eight times money in less than 2 years. So we don't mind having, betting on our conviction. We are kind of our risk appetite is very high. Yeah.
I understand.
So, but broadly now, as you see, the mutual fund is spreading in tier 2, 3, 4 cities. So it is not restricted to only Gujarati and Marwadi community. Now everyone wants to participate into equity.
That's true, but still the proportion is more in that community. And coming back to this, we know now we know you as a CARE PMS founder, and if you want to introduce for your team to our audience.
Yeah, so first let me share one thing. The girl behind the presentation is Sania. I don't know whether she is into participation list. But thank you.
You can just take the names and
yeah, Sania is there. So at CARE PMS, we have a fund management team. It is not the one fund manager. Our senior partner is Mr. Jayant Mamania. So all the credit of outperformance goes to him. Together with Jayant Bhai, we have Amit Doshi, who is also, he has also given a presentation to the PMS Bazaar. So we three are the people who takes the final decision on the fund. Together with this, we have my partner Vishal is looking after the clients. We have one research partner Push, who is heading the research team. So together, total we are 17 people's team, and all are based out of Borivali, Mumbai, Maharashtra.
Thank you. So actually, with that, we've come to the end of the session. I know there are a lot of questions which I haven't taken, but I'll be mailing each of them to you so that each of them is answered.
Be happy to answer, yes.
Because if we're going to take everything, I don't the night will never have an end. So, but all are interesting questions which have fallen onto the podium. I'll mail each of this, and I request you to address all these questions.
Sure. It will be my pleasure. And once again, thank you. Thanks to PMS Bazaar. Big thanks for giving us this opportunity. Thank you very much, Akshara. Thank you.
Thank you. It was a pleasure having you, sir.
Thank you.